SCHD is down bad, worse than it ever has been, especially in a short period of time. Right now, professional analysts describe SCHD fair value closer to $30, so it being under $25 is insane and such a gift. That's about a 20% upside for an ETF that just increased its dividend and continues to give investors so much value. Its most recent dividend in the first quarter of 2025 was up 22% over the March 2024 payout. As of right now, the current dividend yield is crazy high at 4.16%. I know that my clients that have been investing in SCHD heavy and have that as a big portion in their portfolio are super happy right now during this market downturn though. Because if you're living primarily off of your investments and you're expected to take out, let's say $50,000 per year, if you don't have dividend paying assets like SCHD, then you're selling off a portion of the portfolio each and every year. And that's fine if the portfolio grows more than you're selling it off. But in a year like this, when everything's down 10, 15, 20%, and then you have to take out $50,000, you're losing money on that. But if you have SCHD that's giving you a solid dividend and you're not even touching the principal, it's just a dividend coming out even in a down market, that's the ultimate hack. I did think that SCHD would hold up just a little bit better during this all-out assault we're seeing, but even a solid value ETF like SCHD can't hide from the craziness going on. All markets are down, including foreign markets and crypto, but especially these style large cap equities funds during a time when America's going through some interesting dilemmas. So let me explain what's going on, why SCHD is down, why this really isn't a very bad thing, and how I'll be investing in it in 2025. My name is Nolan Gouveia, my students call me Professor G, and I made this channel to make investing simplified. Let's first zoom out a little bit because it's not smart to judge an investment based off of its worst month ever. SCHD's long-term returns are robust with a 13.13% annual return since 2011 and a 14.4% one-year return, highlighting its wealth creation potential. Another huge thing to keep in mind is how much safety this fund provides. Because let's say we have a pretty bad year, and at the end of the year, we're down 5% in SCHD. That's never fun to see a negative 5%, but when you keep in mind that it's also paying you a dividend of 4%, that actually brings the total return to negative 1%, so you're only down 1% in a very bad year. We still don't like to see red, so what's going on? So here's a chart of the new sector balance for SCHD. The blue line is the current balance. So you can see that it's heaviest in energy, consumer staples, healthcare, industrials, and financials. When we take a look at all of the different sectors that are available, over the last month, there's a lot of red. And we can see that worst among them has been energy, and then also materials, real estate, technology's been pretty bad, but pretty much everything on this is in pretty bad territory. Nothing's in the green over the last month. On March 21st of this year, SCHD nearly doubled its energy stock exposure to 21% from 12%. So we just saw that all the individual sectors are down, but the one that's down the worst is energy lately. Tariffs and falling oil prices have been crushing energy, but they're gonna come back up soon, don't worry. And if you're continuing to invest in SCHD during this time that everything is down, and especially down pretty bad like energy, then you're just gonna reap the rewards when everything comes back up to life. SCHD recently had its annual reconstitution and overweighted energy stocks and deleted some financial stocks, which means that a decrease in crude oil prices could possibly hurt the ETF's growth, at least relatively to the portfolio that existed before the annual reconstitution. A focus on cyclical stocks might hurt the ETF performance in case a tit-for-tat tariff war escalated and pushed the US economy into a recession, which would specifically hurt the pro-growth stocks included in SCHD. As of right now, that's what's happening. The trade war is escalating, and so fear and emotions are just taking over. The underlying assets and companies are not necessarily bad. They haven't gotten any worse. They're not just losing money in just a terrible investment. It's just the emotion and the what if surrounding these tariffs and other big things that are kind of out of our control. I know it doesn't seem like it, but this is actually very good news for SCHD. SCHD pretty much holds its value, and so it rarely becomes a steal or an absolute buy, but with it being down as much as it's been down in the last month or so, this is absolutely a steal. I mean, with prices this low, the dividend yield is sky high at 4.16%. Looking at the 101 consensus ratings of top analysts, based on the average price target on 101 stocks derived from Wall Street analysts offering 12-month price targets on SCHD holdings, The average price target is $29.15, with a high forecast of $35.15. So the fair value of SCHD is way higher than what it's trading for right now. And we can see specifically where they're getting that information because a bunch of the underlying assets have so much upside. We have some moderate buy, some strong buy, a bunch of moderate buys, but all of these are in buy territory except for Altria. The upside is around 7%. We got 55% here, a bunch of double digit, 10, 15, 31, 21, 25. And as we go down the list, there's so many different buys within this fund. We have 44%, 40%, 33, 42, 61%. So when you look at an ETF, you definitely want to look at the holdings and figure out, are these good companies? What's the reasoning as to why the whole thing's down? It's not just that SCHD is down, it's the underlying companies within SCHD are down, which could mean that the companies are undervalued, or it could mean that the companies are crashing and they're bad companies. When you do a little bit of research and see, especially with these top analysts looking at them and saying, look, they're down low, my price target is like 20, 30, 40% higher than what they're valued at today. That's just intelligent investing, and that's buying value, buying it at cheaper than what it's expected to be worth. And so that's why this is so exciting for me, and especially for those who like to invest in SCHD. So how much could this investment actually grow, and along with it, your passive income from dividend growth? Looking at this chart from Seeking Alpha, it shows the dividend growth rate in the far two columns. Most of those numbers each year are above 10%, and this 5-year average dividend compounded annual growth rate is 11.6%, which is outstanding. We're gonna need that number for what I'm gonna show you next. So on MarketBeat, there's a pretty awesome calculator to be able to show you not only what will this investment grow to, but also what can you expect your dividend income to be at that point. So let's say that we had about $10,000 invested into SCHD today, but each month we're going to put in $1,000, so that comes out to $12,000 annually. The dividend tax rate is 15% because on long-term capital gains it would be 15%, but if you're putting this in a Roth IRA or an IRA or any retirement account, you don't have to worry about that for now. The initial annual dividend yield, we'll put it at 4%, which is a little bit lower than where it's at today, and a little bit higher than it has been, but I do see SCHD being down for a little bit of time. The expected annual dividend amount increases from that chart that I just showed you before. Now what they had on there was 11.6%, but that's pretty high, so let's just bring it down to 8% to be conservative. And then the expected annual share price appreciation, when we look at SCHD on the actual website, since inception, the total return has been about 13% per year. But we have to remember that there was about a 4% dividend, so 13 minus 4 is about 9%, and so we can kind of expect it to grow at 8 or 9%. Let's just be conservative and say the share price will only grow by 8%. Let's say we have 20 years to invest, and let's look at what happens. So after 20 years, your ending balance will be at about $900,000, which is a total return over 250%. Your dividend at that point will be about $3,000 per month, almost $36,000 per year. The total dividend payments over that time was $225,000, and your yield on cost is 13.3%, which is just amazing and such a high growth. You can also see when you pull down here exactly what it would actually look like. So by year 10, if you wanted to look at that, you'd have about $200,000 in there. Your annual dividend would be about $8,000 per year, and so on and so forth. So here's the thing, right now the whole entire market is down bad due to massive uncertainty and tariffs and the Fed rate changing or not changing. Just a lot of craziness is going on right now. We have an administration that's taking extreme measures, and it's definitely scaring a lot of people. So yes, I would have liked to see SCHD hold up a little bit better compared to the rest of the market, but it kind of makes sense because this is not the same thing as like a financial crisis, because usually in something like a recession, you're gonna see the other types of ETFs like the S&P 500 or maybe high-tech ETFs and things drop a bunch, but then because the types of companies within SCHD are very much recession-proof, that's not gonna drop as much. This is a little bit different of a situation that we're dealing with, and it's just overall fear, just overall in the whole market. So don't get too worried that SCHD isn't going to be as safe as I originally had thought that it would be. For those of you investing for 10 years or more down the road, this is just something that we definitely want to keep in mind and understand that we don't need the money today and we're investing for the future. So this shouldn't change what you're doing here. Another silver lining right now is that if you feel your portfolio is too risky, you've seen it drop 20 or 30% because it was too high in tech, and you've been waiting to put it into something like SCHD with a little bit more value style investing, this is a great time because when the market's down, that means that your capital gains are down. And so if you sell out of something like a little bit of QQQM or some of your Nvidia or Tesla, you're gonna have less of a tax hit there because your capital gain is less, and then you move it over to something like SCHD, which is down as well. So you're able to get it at a super low price and save on taxes. If you're in retirement or close to retirement and you're counting on these dividends, don't do anything right now, just stay put. The dividend's still coming in, and I believe all of this will be back to normal in about a year, maybe a year and a half. So if you can't buy more into SCHD right now, the next best thing you can do is hold and don't panic sell. I personally am buying as much as possible. These prices are amazing. The upside that I showed you earlier in this video is very feasible and within reason. To get to buy in around $24 when the actual value is closer to $30 is very solid. And then to get that amazing dividend and history of dividend growth is just icing on the cake. I'm buying SCHD heavy along with the other 2 ETFs in my 3 ETF portfolio that I go over here in depth. So watch that video to help you to understand what's the most simple investing portfolio that's actually crushing it over the last 20 years. Or watch this video to keep you going strong in your investing journey. And remember to keep investing simplified.